Have you ever had that feeling? You know the one, where the market seems to hunt down your stop loss to the exact tick, and then, boom, it reverses and flies in the direction you wanted it to go. It is maddening. Well, today we're going to put an end to that frustration. We are cracking open the institutional playbook to build a rock-solid, zero fake-out trading checklist. Let's learn how to see what they see and trade with them for a change.
And this quote right here, it just hits home, doesn't it? It feels like it's rigged. Like there are these traders in some fancy boardroom just laughing at us retail folks. But what if I told you it's not rigged? What if it's just a game and you just haven't been taught the rules yet? What if you could get your hands on their playbook? That's where this idea of smart money comes in. And look, it's not some secret club. It's just a term for the big players, the institutions, the banks, the funds, the ones with enough capital to actually move the market. And here's the best part. Their moves aren't random. They're calculated. And they leave behind a trail of clues, like footprints in the sand, right there on your charts.
So here's our game plan for today. We're going to build this thing from the ground up. First, we'll get familiar with the playbook. Then we lay the foundation. And trust me, this is the most important part, by learning to read market structure the right way. From there, we'll pinpoint their exact entry zones using what are called order blocks. Then we'll uncover the why behind the moves by understanding market liquidity. And finally, we'll put it all together into a concrete checklist you can use right away.
Let's start with the absolute bedrock of this entire strategy, market structure. I'm telling you, if you get this one concept right, probably 80% of the fake outs you experience will just disappear. Everything we're about to talk about is built on this foundation.
Okay, so here is the secret distinction that changes everything. There's external structure and there's internal structure. Think of external structure as the big, obvious swing highs and lows that tell you the real trend. Internal structure? That's all the choppy, zigzagging price action inside that big trend. And here's the key. Institutions only care about the external points. A break of an internal level means nothing to them. That noise is where retail traders get absolutely chewed up.
And this image just lays it out so clearly. You see all those little breaks of the minor level? That's where people get faked out. They see that and think, oh, the trend is changing, but it's a trap. The only thing that matters, the only signal the smart money is watching, is that clean break of the major external level. That, my friends, is a real break of structure.
So let's make this our golden rule. Burn this into your brain. A true break of structure is only valid if, and only if, price smashes through the most recent external swing point. And it has to do it with a big, powerful candle, what we call displacement. No little wicks poking through. We need a strong, confident move that screams conviction.
All right, so now that we know how to identify the real trend, we can move to the next piece of the puzzle. We need to find the specific zones where institutions are most likely to show their hand and place their orders. We call these order blocks. But let me be clear, most of the ones you see on a chart are useless traps.
For an order block to be the real deal, it needs to pass a strict 4-point inspection. First, it has to be the last opposite candle right before a big move. Second, and this is non-negotiable, that big move must cause a break of external structure, just like we talked about. Third, the move needs to be so fast and aggressive that it leaves a price gap behind, an imbalance, or a fair value gap. This shows institutional urgency. And fourth, price has to launch away from it, not slowly drift back. If even one of these conditions isn't met, you ignore it. It's a fake.
Now, let's look at this side by side because this is where it really clicks. On the left, you see a perfect, valid order block. Notice how the move from it was powerful? It broke that previous low, a real break of structure, and left that little gap. That's a high probability zone. Now look at the one on the right. See how the move was weak? It failed to break the low. That is an invalid zone. It's bait, and it's likely just going to get run over. This single distinction will save you so much pain. So we've covered the what and the where. Now let's talk about the why. Why does the market move at all? The answer is simple: liquidity. You should think of liquidity as the gasoline that powers the market's engine. Smart money needs it to fill their huge orders, and understanding where that gas is located tells you exactly where they're planning to drive the price.
And just like with structure, there are two kinds. You've got external liquidity, which sits at those big, obvious swing highs and lows. That's the final destination. That's the target. Then you have internal liquidity. This is all the stop losses building up at smaller levels inside the range, like equal highs or lows. This internal liquidity is not the target. It's the trap. It's the fuel stop along the way. And this right here is the aha moment that connects everything we've talked about. Before the real move can begin, before price can go to its external target, it must first raid the internal liquidity. It has to sweep up all those trapped stop orders to collect the fuel it needs for the main journey. Understanding this sequence is how you stop getting in way too early.
And look at this diagram. It shows you exactly how they do it. They will literally engineer these clean-looking levels to entice traders to put their stops there. Then, once enough liquidity is built up, whoosh, they sweep it, absorbing all those orders. That absorption is what gives them the power to launch the price toward their real target, that external liquidity pool.
Okay, deep breath. We have covered a lot. We have the 3 pillars: structure, order blocks, and liquidity. Now comes the fun part. We're going to assemble all of these pieces into a complete step-by-step checklist. This is the blueprint.
We start high level, on the 15-minute chart. 2 simple checks. First, is our trade idea going with the flow of the main 15-minute trend? Yes? Good. Check number 2, and this is the most important filter. Has price already swept a pool of internal liquidity? Has it just run the Asia session high or low? Did it just take out some obvious equal lows? If the answer is no, we stop right there. The market hasn't gassed up yet. The rule is simple. If liquidity is not swept, there is no trade. We wait.
So, the 15-minute liquidity grab has happened. The trap has been sprung. Now, we drop down to the 5-minute chart and look for our confirmation. We need to see a change of character, or a chotch. This is the first signal that the big players are stepping in. But we are extremely picky about this signal. It absolutely must happen after that liquidity sweep. It must be a full candle body breaking structure, not just a flimsy wick. And it has to happen with that powerful displacement we talked about, leaving a fair value gap. If the break looks weak or hesitant, it's a fake out. Again, no trade.
Once we have that strong 5-minute confirmation, we can identify our entry zone. That's section 4. We mark out the 5-minute order block that launched that big, structure-breaking move. That's our point of interest. But, and this is key, we don't just blindly place an order there. This is where patience pays off. We wait for price to come back to our zone. Then, we zoom in one last time to the 1-minute chart for our final trigger. We need to see one more tiny change of character inside our 5-minute zone. That's our sniper entry. If we don't get it, the trade is off. We walk away.
And finally, the business side of the trade, risk management. Our stop loss goes safely behind the entire 5-minute zone, not the tight 1-minute level. This gives our trade room to breathe. Our target? It's that big external liquidity level we identified way back in step 1. We're trading from one pool of money to the next. And the last check is just simple math. Is the potential reward at least 3 times our potential risk? If the risk reward is less than 1 to 3, we skip the trade. It's just not worth it. We protect our capital and wait for a better opportunity.
So if you feel like that was a lot to take in, just boil it down to this one line. This is the entire model, the whole sequence, from start to finish. A 15-minute internal sweep which fuels a 5-minute change of character with displacement. That creates a 5-minute order block where we wait for a 1-minute shock to trigger our entry so we can ride the wave to the external liquidity target. That's it. That's the formula.
But, having the perfect checklist is only half the battle. The real skill in trading, the thing that separates the pros from everyone else, is having the discipline to actually follow your rules, especially in those moments when your brain is screaming at you to break them. That's where the real work begins.
And that really brings us to the final question, doesn't it? We've just laid out the entire institutional blueprint. You have the step-by-step checklist to help you avoid those painful fakeouts. The knowledge isn't the issue anymore. The only question left is, do you have the discipline to actually follow it?